Thank you, George, for that generous introduction. It was so loquacious, in fact, that it took all the material from my speech, so I hope I have something left to talk about. But I thought what I would do tonight was just speak for 20 to 30 minutes, depending on how my voice holds out, and then answer as many questions as you have after that. And I thought I would title this speech, Value Investors I Have Known and Learned From. So I'd like to talk a little bit about my personal evolution as a value investor and some of the people who really helped me along the way and provided a lot of very good ideas and very good practices that I learned from. In a recent stewardship report for the Graham Chair, which George looks after, George signaled his intention to research the topic of what makes a good value investor, and with a focus on character traits that are common among successful value investors, notably their ability to deviate from the herd and take a long-term view. Furthermore, to this end, he said that he plans one-on-one interviews with successful value investors to gather meaningful data. George, I haven't received a phone call from you yet or a Blackberry message, but as a self-described value investor, I'm going to take this opportunity to give you my 2 cents worth of less conventional data to advance your study. Although I highly recommend the works of Graham and Buffett to you, and actually when I was going down the value investment road, Buffett was still a work in progress, so he wasn't the icon that he is today. But I certainly recommend the works of Graham and Buffett, and I'll spare you any attempt at rehashing those classics. But as I said, I'll attempt to focus on the traits of value investors that I've met or personally known that have been very helpful to me. The end result may be pretty much the same as a Graham and Buffett rehash, but hopefully it'll be more germane to those of you who are considering a career in value investing and are searching for some mentors in the process. In my experience on the value investing road, investment mentors have been very important, and even more strangely, most of mine were encountered seemingly by accident at critical times in my career. I consider my first and foremost investment mentor to be my father, who spent his career as what they call now an investment executive. In those days, they used to call him a commission sales rep or a broker. And they have a much fancier title nowadays. He didn't have an MBA or a business degree or even a university degree, but he learned street smarts in the School of Hard Knocks. He was a decorated military officer from World War II, and he was a very courageous and tenacious investor. In fact, of all the successful value investors I've known, he ranks right at the top of the courage chart, along with individuals like John Templeton and my colleague Watsa. So trying to pin down that elusive characteristic of courage, starting with the dictionary definition, which says it's mental or moral strength to venture, persevere, and withstand danger, fear, or difficulty. So there's no room for cowardly lions in the value investment camp. My father always used to say that any successful investor must have the courage arising from the strength of his convictions. I often saw this trait in my father as his being extremely stubborn or not admitting mistakes or not being accepting of change. But over time, he was proven mostly correct and dramatically so. On the other hand, it's sometimes a pretty hard line to distinguish courage from foolishness. And the dictionary definition of foolhardy is foolishly adventurous and bold. So the line between being courageous and being foolhardy is sometimes difficult to draw without hindsight. And the American humorist Will Rogers had this to say about investment hindsight. He said, when selecting stocks, don't gamble. Take all your savings and buy some good stocks and hold them until they go up and then sell them. And if they don't go up, don't buy them. So to be on the right side of courage, the even more difficult to define quality of sound judgment is also inherent, which, as I said, is easier to tell by hindsight. But the same Will Rogers had this to say about good judgment. Good judgment comes from experience, and a lot of that comes from bad judgment. But courage is the most important trait, in my view. The second trait, which I think is very important, is, I called it faith, but it's faith in the value being recognized over the long term. And another saying of my father's that I'll never forget is, he used to say, when I'm bullish, I'm 150% invested in equities. And when I'm bearish, I'm 100% invested in equities. And what I took away from this was, in addition to courage, there has to be an underlying faith in the long-term superior rates of return inherent in equities, and a faith that that value will be recognized over time. The third trait that is very important, and I had a hard time trying to define this one, but I would call it an investigational mentality. And I'll tell you a little bit about how I learned about that. And as George said, I worked under John Watson at Confed Life, and John Watson was my next great value investment mentor. He was Director of Investment Research at Confed Life when I joined as a junior analyst in 1975, after I graduated from this august institution. John initiated myself and many others, including Prem Watsa, into the previously unknown gospel of Graham and Dodd. Although I had been vaguely aware of its existence, it was unfortunately, at that time, merely a footnote in my Ivey investment classes. I was told that it was the product of the Stone Age of investment research, which had recently been superseded by modern portfolio theory. But not having yet formulated my own investment philosophy, I was duly inspired by the logic of value investing and the concept that buying at a discount to intrinsic value. One of the watchwords at Confed in those days was, they used to say, investigate before you invest all the time. And although this rather trite saying seems obvious, it was really brought home to me early on by my contact with a gentleman named Tony Errol. And Tony, as you know, is one of the founders of Burgundy Asset Management, another value investing shop. And he has spoken at this gathering in the past. But at any rate, at the time that I first ran into him, Tony was a senior analyst for a boutique institutional brokerage firm. And over lunch one day, I figured it was probably around 1979, Tony presented a group of us with his well-researched case for selling a blue-chip Canadian stock called Massey Ferguson. And for those of you who've never heard of this company, you're about to find out why. Of all things, Tony was recommending selling one of Canada's major industrial concerns, a global producer of farm equipment. To make a long story short, Tony honed in on the fact that the bulk of Massey's profits were related to liberal FIFO inventory accounting methods, which were particularly distorted financial statements in times of inflation, which was very rampant in the late 1970s. So, and he came to the conclusion that basically Massey Ferguson didn't have any sustainable operational cash flow, and that in fact it was really in trouble despite the fact that it was reporting record earnings per share. This was indeed sacrilege to any red-blooded Canadian equity investor. I promptly informed my father of Tony's findings, and I urged him to sell his Massey Ferguson shares. But my pleadings fell on deaf ears. I think I inadequately regurgitated Tony's analysis, and I probably came across as less than convincing due to my own shock over the implications. But within a year, Massey Ferguson was bankrupt and in need of a provincial bailout. And just as a footnote, I discovered that a company called AGCO purchased Massey's farm equipment brand in 1995 and still sells the tractor globally under that name. The fourth trait, which is very important, again, for lack of a better word, I call a contrarian streak. You have to be able to go against the grain and stand apart from the crowd. And the real icon in that sphere, in my experience, was Sir John Templeton. Although I didn't know Sir John personally, I did meet him on several occasions, and I benefited greatly from his wisdom. John's ability to stand apart from the crowd and go against the grain were truly legendary. I had to check my notes on this, but I will never forget attending the annual meeting of the Templeton Growth Fund on July 24th, 1980, at the Sheraton Hotel in Toronto. And those were the days when adulatory crowds were sparse and skeptics abounded. John, not Sir John at the time, had gone on record 2 years previously that he thought the Ford Motor Company was a very cheap stock and represented outstanding value, and he loaded up his portfolio with it. But in July 1980, the stock was down dramatically, and the inevitable question arose, Mr. Templeton, do you regret buying Ford stock, and why haven't you sold it yet? Now, according to my follow-up notes, which were taken in 1989, the shares of Ford Motor Company were selling at $6 per share, and the company was losing money in 1980. After a pregnant pause, John responded that no, he didn't regret owning Ford stock, but he certainly wished that he had waited a little bit longer to buy some more. And then with a straight face, he said that he fully expected that Ford, which was selling at $6 a share, would earn $4.50 a share and sell at $44 over the next cycle. And he was adding to his holdings. According to my notes, in 1987, the stock traded at $56 and earned $11.20 a share. You could have bought it for 50% of its future earnings in 1980. Incidentally, at the same meeting, John recommended purchasing a stock called General Public Utilities, also selling at $6 a share. It had recently, as some of you may have read, experienced a nuclear accident, an accident at a nuclear reactor, and was losing money, something like the TEPCO situation in Japan a couple of years ago. In fact, I had owned the stock myself, but was frightened out of it when they were forced to cut their dividend because of financial pressures. And I was financing my purchase on a bank loan, so I couldn't afford to keep it. Another lesson, not to over-lever yourself. But again, it continued to go down, and John went on to say that he felt it was a classic example of an out-of-favor stock, offered tremendous opportunity. he felt the regulators would ultimately allow it to earn a reasonable rate of return and the dividend would eventually be restored. By 1987, the regulators had complied and the stock traded at 38. There's also an urban legend, I don't know if it's true or not, I've heard it retold several times by people who should have known, but there's an urban legend that on the day the market crashed in 1987, John Templeton called his trading desk to ask his traders what was happening. Most of the traders were fixated on their screens, watching their stocks crumble. When John learned that nothing much was going on in the trading room, he pointedly asked, "Why are we not buying?" And buy they did. And they did very well as a result. These stories exemplify Templeton's ability to walk the talk when it comes to some of his famous aphorisms, such as buy at the point of maximum pessimism, and also, if you buy the same securities as everyone else, you'll get the same results as everyone else. Incidentally, if you're not familiar with the Templeton story, I recommend a recent documentary that was released, and it's freely available on YouTube, I think it is, a number of different sites. It's called Contrarian. The closest thing, also I would like to mention Irving Kahn. The closest I got to Irving Kahn was at his teleconference that he had here at the inaugural session at the Ivey, Graham Chair at Ivey. However, I did know one of his sons, Alan Kahn, who always took a keen interest in our firm's activities and shared many of his ideas with us. Alan summarized his family's contrarian approach in a 1995 edition of Barron's magazine. And Alan had this to say: "Stocks rarely get priced at sharp discounts to intrinsic value without the market perceiving correctly or incorrectly that there are troubles in the company. Our job is to analyze whether these troubles are permanent or temporary. Is it a skin blemish that can be cut out with a paring knife, or is there rottenness to the core?" Once again, Will Rogers had, I think, summarizes the contrary approach very well. He says, "Always drink upstream from the herd." I think the more I was thinking about this on the way over, I think a lot of the importance of this contrarian approach is to be able to see opportunity in adversity. And that's what the best value investors are able to do. And I was just thinking of a story which I had heard, and probably most of you have heard it before too, but I'll tell it again. And it's all about somebody who perceives opportunity in adversity. And there was a young man who was working in the produce department of a grocery store. And he was very anxious to get ahead and very hardworking. And a customer came up to him one day and said, "I would like to buy half a head of cabbage. Is that possible?" And the young man said, "Well, just a minute, I'll go back and talk to my manager." And he went back to talk to the manager, and he was shaking his head. He said, "Some horse's ass wants to buy half a head of cabbage." And the manager looked at him, pointed at him. He looked behind him, and the customer had followed him back to the manager's office. And so he turned around to the customer and said, "And this fine gentleman is offering to buy the other half." So he got a promotion, and he became manager of the produce department because of his ability to find opportunity in adversity. And one day, there was a shipment of produce that was late arriving, and he asked somebody, where's the truck, where's it coming from? And the guy said, well, the truck is coming from Montreal and it's late. And he just lost it, and he said, you know, Montreal, that's a terrible place. There's only hockey players and hookers live there. And all of a sudden his manager was behind him and said, hey buddy, wait a minute, my wife's from Montreal. And he said, well, what team did she play on? So, you know, it's possible to see the glass as half full in the most adverse of circumstances. The fifth character trait I want to mention is, I call it emotional detachment. The problem is it's very difficult to be a contrarian when emotions are getting the better of you. I'm going to digress a minute from value investing per se, and to highlight some wise words of a great technical analyst that I once attended a meeting with by the name of Joseph Granville. And he taught me that seeking approval of your investment ideas from other investors, analysts, or even looking for confirmation in the marketplace can be counterproductive. In the early 1980s, I was invited to a presentation of Joe's, and they were always entertaining. In fact, I remember I read one of his presentations. He said he was going to walk on water, and everybody came to watch, and there was a big swimming pool, and he had secretly put a plexiglass platform underneath the water, and he started walking on water, and people just couldn't believe how he was doing it. But so he was a very dramatic showman, but he always started out his presentation by asking the audience, what do factors such as earnings, interest rates, and fundamental research have to do with the future course of the stock market? And he had trained his audience always responded with the appropriate response, which was nothing. And they always replied with a thunderous nothing. And his famous mantra was, the obvious is obviously wrong. But perhaps his most important saying for me was the stock doesn't know that you own it. In other words, don't become emotionally involved with the fluctuations of your investments. Just because you like it doesn't mean anyone else will or should. And you may have to be a minority of one for some time. My dad always used to say that he had seen many investors stumble because they changed their mind as a result of negative chatter they heard on the subway going home. Or worse still, as a result of mulling it over with their exasperated significant other once they got home. So don't depend emotionally on the day-to-day price fluctuations of your holdings and the affirmation or non-affirmation of others. And finally, you know, in the background is this quality of, I haven't mentioned, but goes through all these traits, which is extreme patience. All of these traits need to be seasoned with an ample dose of patience. Rome wasn't built in a day, and as Napoleon Hill says, patience, persistence, and perspiration make an unbeatable combination for success. So to sum up my interpretation of those traits that make a great value investor, the ones that I've talked about are courage, faith in the emergence of value over the long term, an investigational mentality, a contrarian streak, emotional detachment, and a great deal of patience. So finally, I'd like to give just a brief overview of our firm, which I joined 27 years ago, Hamblin, Watsa Investment Counsel. It's a wholly owned subsidiary of Fairfax Financial, which is an insurance holding company with global subsidiaries in property and casualty insurance and reinsurance markets. Hamblin Watsa manages the investment portfolios at Fairfax and all its subsidiaries, centrally out of the Toronto office with a small team of analysts and portfolio managers and traders. The portfolio amounts to about $25 billion worldwide. And our investment philosophy is grounded in the value approach for both equity and fixed income securities. And we try and bring these traits into practice every day. And because we're an insurance company, for regulatory and internal policy reasons, our portfolio is predominantly slanted to fixed income, which typically accounts for about 75% of the mix. But equities, convertible bonds, and equity-like fixed income vehicles have been a significant component in generating above-average portfolio returns. The investment team consists of 6 portfolio managers, 7 analysts. We have 5 traders and 12 compliance and administrative people, so it's a pretty small office. Our investment committee, which oversees all the investment decisions, consists of 6 portfolio managers plus the chief compliance officer. Our equity and investment philosophy is long-term, at least 3 to 5 years as a rule. It's bottom-up. The focus is on intrinsic value and not forecasting the economy or the markets. And focused on margin of safety through the minimization of financial risk, through in-depth financial analysis. We do all our own analysis. All our portfolio managers are analysts first and foremost, and we don't delegate the financial analysis part of it to brokers or ratings agencies. We certainly read what they have to say, but we do our own work on the financial analysis side. And of course, we're trying to minimize price risk by buying at a discount to intrinsic value. We aim for an absolute total return objective in equities of 15% per year. I don't know, with interest rates where they are these days, we may have to lower that one. On the fixed income side, we operate in a similar fashion, and we're really looking to put as many equity-like instruments into the fixed income side as we can to increase our returns where it makes sense. And we try and take advantage of special features like put features, warrants, and we also, on the fixed income side, do a lot of investing in what they call fallen angels. I don't, reluctant to use the word junk bonds, but they're high-yielding securities of companies that have fallen on hard times, but that are, in our opinion, still viable concerns. I'd be happy to answer any questions you have. Thank you.
My main question is, what kinds of risks do you guys look at while making an investment? Because I know, as a value investor, you don't think of market volatility as the sole risk on investment, and beta is not really relevant. So, what kind of risks do you guys look at in your fund, and do you attempt to quantify them or just think about them?
I would say increasingly we do, in terms of the financial analysis, we do the kind of a fixed income driven approach. So, we look at the financial ratios, cash flows, debt covenants. We want something that's going to at least survive a cycle, and so we can get some return out of it. So we just look at traditional measures of risk, much like Moody's and S&P or DBRS might do, but the difference being that we do it ourselves, and we find that the traditional public work that's done in that area is often, it's not very proactive, and it's often late in the game. Like they don't change their ratings till after the horse is gone. So, we try and anticipate that, and debt covenants are very important too. If we see if there's a debt crunch on the horizon, there's a maturity on the horizon, and there isn't any cash flow in view to deal with it, then that would rule that out pretty quickly.
Thank you.
Hello.
Hi.
So I think this is probably the topic a lot of people are wondering about. Fairfax's large investment in RIM. And from a value investing standpoint, I think a lot of value investors try to avoid tech stocks.
Right.
So just curious as to that decision, did the value come from patents on the balance sheet or as an ongoing concern? And sort of how did that come about within the company? And there must be some dissent as to whether it is in fact a value stock or what its future is going to be.
Well, yeah, it's it's a tough one, but I think, and I don't want to speak too much about it because it's still a work in progress. But certainly we were very lucky to get the current chief executive that we have in place, and he's doing all that he can to surface the value. But yeah, I agree. The tech stock area is a very difficult one because the value of the assets can change overnight, and something that's is very competitive one day can be obsolete the next. So I agree it is a challenging one, but I think in the case of Blackberry, one of the aspects was that had no debt, and it has a pretty good level of cash. But yeah, it's really going to depend what John Chen can make of the assets. But we did a lot of due diligence, and felt that there was enough of a cushion to proceed. And in fact, a substantial value cushion, even in the most pessimistic scenario, basically a meltdown scenario. We could see at least getting our money back. But yeah, it's a work in progress and remains to be seen. But we did our due diligence and felt the realizable value was considerably higher than what the stock was selling at, particularly in the latter stages.
So is that a stock that we can discuss, I guess, that you can say how you made the decision to buy it?
What?
Is that a stock that you can discuss or how you decided?
Well, yeah, there's a lot of, as I say, in the last 5 years, well, 5 years ago in particular, we had to deal with a lot of distress and did a lot of distressed investing. And one example of a situation, and traditionally it's an area we would like to be involved with, but we didn't have the critical mass or the capability to do this in terms of making deals on very short notice in very large dollar amounts. Traditionally we've just made passive equity investments in marketable securities, public securities. But an example was we had previous experience with a company called H&R REIT, for example, which was were managed by the Hofstadter family in Toronto. And they had come to us many years ago and asked us to invest in their REIT, which we did, and we invested very successfully in it. And so we knew them very well. And one day in the financial crisis, they came to us and said, and that we had actually sold the REIT many years earlier, sold our investment, and the stock actually, during the financial crisis, came down dramatically, and to below levels where we had purchased it several years earlier. And they came to us and they said, look, we've got a problem. We're building an office building in Calgary called The Bow, and it has a 20-year lease from Encana and Cenovus, I guess it's called, and what was Pan-Canadian Petroleum originally. And they said, we've got a 20-year lease, and we've got the foundations in place, and the bank just pulled all our financing, and they won't deal with, they won't even talk to us. Can you help us? And we said, well, we think we may be able to work something out. So we satisfied ourselves that we knew we were dealing with good people. We knew they had, unfortunately, perhaps overextended themselves. And, but we were able to negotiate a deal which was, I thought, very favorable to us, but they thought they were quite happy with it too. And as John Templeton also says, when you bail somebody out who's in distress, you're doing them a service, and they're very thankful for it. And they were very thankful that we essentially provided bridge financing for them until they could get financing themselves. But we took, like Buffett, we did a warrant type deal, and we had high yield debt, like the fallen angel concept I talked about. And within a year they had refinanced the deal, and was very profitable.
So you cover global equities,
Right.
and that's a huge universe to choose from.
Right.
How do you go about finding these stocks to include into your portfolio?
Globally, I guess about 15 years ago, we weren't involved in global equities, and I remember my partner Prem called a meeting and had the portfolio management group and analyst group, which at the time was even smaller than it is, much smaller than it is now. There were 3 or 4 of us, and said, I'm a great follower of Templeton, who believes in global equity investing, but we're just buying North American equities, and how do we do this? And we scratched our heads for a long time, and there wasn't a magic bullet, but we came up with a number of strategies which we applied simultaneously. And one strategy was to find people globally who shared our investment philosophy in specific areas of the world. And Templeton's approach was, to look for distressed areas of the world where equities were selling at rock bottom prices, and to go in somehow. He even went into Japanese and Korean equities when he couldn't even get his money out initially. But we did actually use many of Templeton's contacts in various countries that we felt were distressed, and he also had used money managers in those countries or specialists in those countries, and so we invested small amounts of money with them, and they were quite happy to share their ideas with us, and they didn't mind us piggybacking their ideas, of course after they got their own positions, but it worked quite well, and we actually developed contacts with managers I remember in Korea and in Brazil and in Russia. We were with one of the early groups in Russia. Now, those markets were extremely volatile, and we went in with our eyes open, and we knew that if one of these markets goes up very strongly in a very short period of time, that because of the extreme volatility, that it's usually wise to take a profit. And we entered and exited in a number of emerging markets. We learned a lot about them. We don't have anything in Korea or Russia at the moment, but we do have some interest in Brazil. We have a wholly owned subsidiary in Brazil, but we're actually using, at the moment, we're using a local local investment manager in São Paulo, who's a value investment manager. In India, and the other approach, apart from finding like-minded individuals and groups, was we hired somebody, Chandran Ratnaswamy, who is now in charge of the whole emerging markets equities area for us. But we basically hired him to just go knock on doors in Asia to, look at whatever research publications or business publications, find who were the best people, who ran the best companies, who were the most honest people, and basically just try and meet them and travel around and knock on doors, which he did for the better part of 10 years. And so we developed quite a network in India. We have a joint venture in India with an Indian bank, and it's an insurance company joint venture. And but we have a minority interest, so we don't actually make the investment decisions, but we basically handpick the investment team that is in Mumbai, and Chandran is handpicked them himself and advises them, and they but we have a really good value team there. They're as I say, they're somewhat independent, but it's a very strong team. We're building out some investment expertise in the Middle East. We have a joint venture with the Kuwait investment company in a company called Gulf Insurance. And we own, I think it's 49%. Again, we don't have investment discretion, but we do advise them, and historically they haven't had any equities in their portfolio, and we have an individual on our research team who is spending a lot of time over there and is coming up with some very good value ideas, admittedly in some pretty distressed places like Egypt. But it's been very successful so far, and as I say, that there's really not a culture of equity so much in the Middle East. So, and then over the course of the years, we've developed, because of these approaches of knocking on doors and meeting with like-minded people, we've developed our own internal capabilities as well. So, but it's, we very much follow a Templeton approach in the sense of, we're looking for distressed areas of the world and trying to get into them. And actually, another example is, I should mention, is Greece, George. I don't think George likes Greece very much, but when Greece, and they may not be out of the woods yet, but when things really hit the fan in Greece, we sent a SWAT team to Greece, and in fact, I was one of the team members. But one of our teams has spent a large portion of his time actually in Greece, and we went in there and we were looking to make some substantial investments in Greece. We were looking to get into the insurance industry in Greece. Like, that's also one part of the model is, we would love to buy insurance companies in these distressed areas, because then we can, if we can control the investment portfolio of the insurance company, we have immediate access. And one of the other approaches we're in India is we recently, again, there was a distressed opportunity. The Thomas Cook Company in London, in England, they do travel and foreign exchange, but they had a subsidiary in India. But anyway, they had some severe financial problems, and they wanted to sell their Indian subsidiary, a control block, and we purchased that. But it's enabling us to, really, it's in many ways more easier and advantageous to actually own an operating company in a place like India, and make investments, from within rather than being perceived as an outsider. But so Thomas Cook of India, it's an operating business, but it may be possible for us to make investments through it as well. Yeah.
I just have a question about sort of like the role you play in each of your investments. So like, is it like, do you guys take an active role in each of the investments, or is it kind of like something that sort of Buffett talks about, sort of to avoid the labor issues, or sort of like allow management to sort of continue to operate their business?
Right, yes, that's a very good question. As I say, historically we've been just kind of passive investors in publicly traded securities, although I remember one instance in my experience where we were trying to be very scrupulous about this, and it was a company where there was a proxy fight. And I remember talking to Prem. I said, this guy, I won't tell you what company it was, but this fellow who was waging the proxy battle came to us and said, the current management's no good. They've been stringing along for years. We've got this plan to make things happen, and we really want you to support us. And we said, no, we can't do that. As a matter of policy, we don't do that. And anyway, this kind of went on for some time, and it got very contentious, and it was so close that basically we had to vote, and even if we abstained, we would be in effect voting for somebody. So So we ended up voting for the hostile proxy, but, we were trying to avoid this kind of thing all the way along. But, no, as a rule, we don't take an activist role, usually. As I say, with a lot of the investments we made during the financial crisis, it was a question of, well, in the case of H&R, the management was in place. In the case of something like the BRIC, that was a pretty much of a catastrophic situation, and we had to replace the management. But, I guess you could say the same thing about similar about Blackberry as well. But it's not something we like to do or get involved with unless it's a catastrophic situation. We would prefer to deal with existing management and let them do their thing.
Thank you.
And I guess the other thing is, if you're going to be an activist manager, it's just silly when I think it's just silly when I read about, guys buying 5% of Apple or something and then trying to tell them what to do. I just think that's a complete waste of time. And that's not something that we would do or even attempt to do. But if you can, if you can get a significant enough position in a company, where you're not beating your head against the wall all the time, then that's another story, I guess. But
Thank you.
okay, yeah.
Hi, thanks for coming. 2 weeks into the course, it seems like value investing is a very hands-off kind of practice where you do your research, pick your stocks, build your portfolio, and then just sit and wait. So my question is, as an amateur value investor, is it wise to invest and play the value investing game as a part-time thing while pursuing a career in a different?
Yeah, no, I guess I've been emphasizing, and some of the questions have been directed at sort of the Hamblin, Watsa, Fairfax experience, but we and myself personally, we are historically we've always, well, at least from the beginning, we invested in in very small companies, and we didn't have to invest large amounts. Like now, because of our size, we have to make very significant investments just to move the dial and take very contrarian stances, right? Because once you get to a certain size where you're almost equal to the size of the market itself, it's very difficult to get a above average return. But no, and if you read Irving Kahn, he used to always just deal in over-the-counter securities, and Ben Graham did a lot of that too. Small companies selling at big discounts. I think it's a great way to go. I guess the only thing, and it's pretty accessible to anyone. I think the only thing, from my experience, is some of the smaller situations. That the companies don't have a kind of a critical mass, which makes it difficult, can make it very difficult for them, if they encounter a bump in the road. And I really had a couple of strange experiences. The conventional wisdom is, if you're buying a company where the founders or the managers own a significant stake, that's supposed to be a good thing. it sounds reasonable, and it is reasonable in most cases, but I encountered two situations which did not work out very well for us, you know, which were smaller companies. And one was an instance, it was an engineering company, and it was a bunch of engineers basically controlled the company. It was a public company. And so everybody worked at the company, had a few shares in the company. And we thought this was great, and that the CEO had shares, and all the executives had shares. And then they ran into trouble, and we went in one day to speak to them and sort of said, well, you know, there's some problems here. You guys have got to do something. What are you going to do, right? And the president of the company, it sort of came out that, you know, well, you know, I've got $50,000 worth of stock. You know, that doesn't mean anything to me. I just as soon walk, right? And that was the attitude of all of the shareholders, was, you know, all these management people that own shares, that they didn't own enough shares to make any difference, right? And they were probably making most of their income on salary and bonus. So, you know, that didn't work out too well. And there was another smaller company where the founder controlled the company through voting, you know, super voting stock. And again, when push came to shove, he really didn't care what, you know, the company got into problems, the stock went way down, and his stock wasn't then worth very much. And so he didn't, turned out he didn't really care what happened to the company. And he would keep writing himself up every year. He would keep declaring big bonuses for his services, which far outweighed the value of his stock holdings, even though he controlled the company. So you can get some very strange things going on with some of these smaller companies.
Thank you for that pearl about smaller cap stocks. I'm going to ask for two more pearls if you're willing to give it to us.
Yeah.
When you're evaluating equities in particular,
Yeah.
do you have an emphasis on the asset value, or maybe more of an emphasis on the earnings value of that equity?
Well, that's a good question, and I guess I've kind of, you know, worked with a number of systems, but I guess, or a number of approaches, and I guess these days it's, you know, and I think it's partially because we're dealing with bigger companies. These days, I mean, I remember Buffett said something at some point that, you know, he just does a back of the envelope calculation on discounted free cash flow, and that's pretty much the way I approach it, right, is looking at discounted free cash flow. Now, there may be and, you know, there's an approximation formula for that, you know, that Graham uses, you know, and there's the question of the dividend model and the earnings model and so on. But, you know, I think that's just a really simple kind of rule of thumb. But, you know, I mean, in the past, though, we probably did use asset value in certain situations, like the so-called net working capital stuff that Graham used to deal with. I mean, that was around in the 1970s, and he wrote a piece called The Renaissance of Value, I think it was called. And you know, there was a broker I remember who published a list of net value companies. A guy who worked for Oppenheimer in New York, and you know, he used to publish it every month or every quarter. It used to be this great big thick thing, and then, you know, every year it got thinner and thinner, and then, like, you know, in the 1980s it basically just disappeared altogether because there wasn't, you know, there just wasn't anything around that met those kind of criteria. You know, I would say I also learned at Confed, in particular, we in the research department, they used to have something, they called it the metals team. And so the metals team, everybody who was, all the analysts had to be a member of the metals team, and each analyst got a metal they were responsible for, like zinc, nickel, copper. And, those were the days when mining stocks were very important, and you had to get them right in terms of your if you've got a portfolio that can only buy Canadian stocks, which was actually our most of our mandates initially were Confed, we had to manage Canadian-only portfolios. So we had to learn how to deal with cyclical stocks, like metal stocks. And, what came out of the metals team was that, you had to buy really it was, trying to predict the metals prices was basically a waste of time. You had to, the only way of making money in them was to buy them when they were losing money, and to sell them when they were making money. And, that would be using you'd have to average the earnings over a cycle and, do your PE on that basis. Because if you did it on current earnings, you'd be wrong all the time. And I remember having a discussion with Prem about this once, and I said, this is truly an amazing discovery. Like, why is it that, when you buy a deep cyclical stock, when they're losing money, they're laying off people, they're omitting their dividend, why is this, it always seems to be a good idea, right? And he reminded me that, Roger, haven't you heard of the law of supply and demand? If you have a commodity and they're losing money, the commodity producers have to reduce production. And if it's a free market, they invariably do. And then the inventories disappear, and then the prices go up again. And we were able to apply that many times. And I remember one situation a few years back was, some of them you could do that over and over again. And one that comes to mind in particular was a company called Methanex, that produces methanol. And there was a huge oversupply of methanol at one point, and the stock was extremely depressed. But you could see that everybody was cutting back production, and these were the guys among the lowest cost producers. So that's very important too. Yeah, you could go with the lowest cost producer, but it was extremely. Extremely valuable approach to have that knowledge.
If I might ask one follow-up
Right.
question. When you do decide an investment, an equity is below its intrinsic value, how much of a margin of safety do you apply to that?
Well, that's a good question, and I think you can, as I say, what I tend to do a kind of a discounted cash flow, so in my head. But, I also use that formula as well. But, all I do is I use a high discount rate and a low growth rate. So, you have a very high hurdle rate and you make very modest growth assumptions, right? And if it comes out looking good, then it's almost like a no-brainer. I mean, of course, your growth assumptions could be wrong, but if it's very conservative, it won't be.
Hi, thank you very much for coming. My question relates to your thoughts on the development of the traits you were talking about in your speech. So what I was wondering
Sorry,
is
the development
of the character traits
Yeah.
you spoke of.
Yeah.
And we all develop personality types before we reach a certain age, and we get fixated on a certain belief, what we think our morals are, success is. Do you believe that as a value investor, we truly develop those traits, beyond a certain point? After that, it's really hard for someone to become a value investor.
Right.
Do you believe in that idea.
Sorry, I'm kind of missing, what did he say, George?
Are you talking about whether you are born with it or you develop?
Yes.
Yeah.
Exactly. Are you born a value investor? Do you truly develop those traits?
Yeah, that's a good question, and I don't have the answer to that. Although I think it was Buffett who said that I think you have to you have to sort of be be inoculated by it or something, right? Like it has to be something that clicks very quickly, right, with you, or it probably won't work. I mean, and I have, and there's lots of ways of going about in the investing community, the investing world, and I mean, I know one individual, and he says, look, I just can't, I can't do this, right? I know you have to do this, and I just simply can't do it. So he does something else, right? And he does fine, but it's not something I would call value investing. So yeah, I think it's something that has to click right now. And if it does, then you can certainly develop it more. But yeah, I don't know. I can't predict who it's going to click with or not.
Thank you.
Okay, yeah.
Given the regulatory constraints that Fairfax faces, how did you position the portfolio to weather the financial crisis so well? And do you think there's risk of Canada heading for a similar financial crisis?
I'm sorry, a risk of what?
Of Canada heading into a similar financial crisis?
Well, that's a good question in terms of future risks, and I think you should probably save that one for the Fairfax annual meeting. But in terms of the financial crisis, we were fortunate in the sense that actually I'm historically, I don't, have not paid, as I indicated earlier, I haven't paid any attention to, economic forecasts or market forecasts or even economics in general. I mean, I took a lot of economics courses at university and an MBA, but and I remember one of my first days at Confed Life in the trading room, and the guys were coming in and saying the Fed is doing this and the Fed is doing that, and I sort of said, well, who the hell is the Fed, right? And why does anybody care? I've since come to learn a lot more about that by studying it. But what happened at our shop was that, around the turn of the millennium, our fixed income guy started to, who had an equity value investing background, Brian Bradstreet, his name is, and he, approaches fixed income with very much an equity-like mind, a value investor mind. But, he was getting very worried about, some of the things that were going on in the mortgage markets and the housing markets. Well, particularly this, these collateralized debt obligations and stuff, like brokers were coming to him with all these securities, mortgage-backed securities and so on, and he just felt that they were totally almost fraudulent, and there were all these pools of asset-backed pools and all kinds of things that were selling, and the yields were very low. And anyway, he just kept following that, and he kept bringing it to our attention over several years, and the situation just got worse and worse, and just seemed extremely silly to us, and markets in general were going higher and higher. And so finally, Brian said at our investment committee, what, and Pram agreed, is how can we, things are going up and away, and the underlying quality is is very poor, and it looks like there's going to be things are really going to come unglued sooner or later. And, you know, we took the approach of, you know, Prem said, well, how can we take advantage of this, right? I mean, are we just going to sit here and watch it unravel, or are we going to try and take measures to, A, protect ourselves from this, and B, perhaps even profit, you know, make money if it does unwind. And we had to rack our brains as to how we could do both those things. And you know, one was we decided, again, unusual for us, but we decided to, you know, one way of insulating ourselves would be to short sell some of these mortgage companies that were extremely overextended. Probably the biggest idea was to buy CDSs, to buy credit insurance on the companies that we felt were most at risk, which were mortgage companies and banks. And you know, but the good thing about that was that you could buy that insurance very cheaply, and you know, it was like buying an option. The risk was no more than the money that you put up. Now there was aspects of counterparties and so on, but and we also figured, you know, if this thing did unravel, that it would actually be good for the government bond market. That the yield, there'd be a rush to quality in the government bond market. So we took out, you know, huge positions in government bonds of very long maturities. You know, we sold some overextended mortgage stock short, and we bought, you know, I think it was like $1 billion worth of credit default swaps, credit insurance. And you know, and we weren't taking too much risk, right? It was more a defensive move than anything. And you know, strangely enough, you know, things did unravel, and when they did, we had a huge amount of cash because we had government bonds that yields went down, the values went up. The values of the credit default insurance went way up, like, you know, multiples of what we had paid for it. And, you know, we were able to cash out those positions. And so then we were able to buy a lot of distressed securities on the other side. Now, you know, are we out of the woods? As I say, that's not my bailiwick, and I don't think that's necessarily part of value investing either, right? But I mean, Fairfax as an organization has, you know, we have mark-to-market accounting on the investments. I mean, that's a whole new thing, and I know Prem was going to be talking about that at the annual meeting, but you know, the ratings agencies and the regulators, you know, they look at these mark-to-market kind of moves, right? So we've been very worried that, you know, if there was another crisis of some sort, that, you know, we would be, we might be putting ourselves at risk, right? So we've probably been overly worried about that, but. You know, and in terms of the Canadian market, you know, the Canadian economy has largely escaped many of these problems, but you know, frankly, they seem to have escaped a lot of these problems, but frankly, I'm not sure that we've had to take our medicine yet, and we may have to. But.
Thank you very much for coming. At some point, you mentioned fixed income and fallen angels. And how can you apply value investing concepts to fixed income while there are financial instruments with the maturities whereas equities don't have a maturity. So what are the, what's the upside in investing in fixed income instruments?
Sorry, which instruments are you talking about?
Fixed income, you mentioned fallen angels at some point?
Sorry, the what?
Fallen angels.
Yeah, no, we look at, we generally buy longer term fixed income securities, because they have more equity-like returns. We're not in fixed income securities to pick up a couple of extra yield points. When we buy the fallen angels, we're basically looking to buy a closet equity security that's classified as a bond. And the most equity-like securities, fixed income securities, have the longest maturities.
Thank you.
Although there are exceptions, but yeah, in general, yeah.
So we're running out of time now, so I'll ask a couple of questions. One is, what is the most, what the biggest mistake an honest investor makes?
Yeah, well, I can think of a few right off the top. I'm sure most of you are aware of them, but certainly the Fairfax, we've invested in some media companies that have done very poorly. The CanWest company, CanWest Media Company, and Torstar company. Torstar is still with us. CanWest is not. I think, I'll speak about CanWest since it's not active anymore. But, that was a situation where, to be quite honest, the whole media space is not something I feel I understand very well, and even less so now, I think, after that. But, with CanWest, I remember one of our analysts, did a lot of work on it, and it was a case where you could look at the asset value in terms of the value of the subsidiaries, and a number of them were public companies. And, I guess the same kind of logic used to apply to Torstar as well. But, so you could see that, hey, if you get in a pinch, it's decentralized and you can sell a few things here and there. And, but I remember, as I recall, the case with CanWest was they had an Australian subsidiary, and they also had a lot of debt. But they could have sold off any one of the subsidiaries and basically eliminated their debt. And they put up the Australian subsidiary for sale, and an Australian company was willing to buy it, and I think they came within pennies of agreeing on a price. And I think CanWest could have taken a lower price and completed the sale, but for whatever reason they didn't. And the entire market went south after that, and the financial crisis and everything else. So at that point they couldn't sell anything. So they were in a pickle. So that's that's what can happen, and that's a good lesson too. What can happen, when you're buying an asset-rich company or a company that has a lot of subsidiaries that you think have independent value or could be spun out. That may be the case, but you've got to have the management of the company has to recognize that and has to act on it. And there's something to be said for you know, for acting quickly, especially if you see, you know, if you know you've got a difficult challenge balance sheet or something like that, and you know you've got assets and you know you can do it, but you've got to execute in a timely fashion.
Last question. What is the most important lesson you learned in investing and in life over the last 30 years?
Are you saying investing or life or both?
Both.
Well, you know, I don't think I'm going to deviate from the kind of traits I was talking about. Yeah, you know, I just think yeah, you've got to be your own person, and you know you've got to be true to yourself, and not you know, basically not rely on you know, other people's opinions or media opinions or market opinions. You know, you've got to, as in life, you know, you've got to work it out for yourself, and you've got to come to your own conclusions, and you know, you've got to be able to back those up and live with them.